Well, from gold mining to gold bullion, I'm really delighted that my friend and someone who knows a lot about gold bullion and the gold market himself, Jordan Eliseo, he's from the Perth Mint, and he is the manager of listed products and investment research. Jordan, welcome to the Virtual Gold Conference.
Hi, Kerry. Thanks for having me.
Well, look, things are pretty good, but it's been pretty interesting in the gold markets. We've had lots of chat. We've heard from Grant Williams. We've also heard from Brent Cook about gold equities. We've heard from a number of mining companies, and some of them have had some fantastic, not only results, but really interesting times and lots of news flow coming out. But quarter one in the physical gold market hasn't been the best, and people are kind of wondering what's going on. I'd really love your views on what do you think is going on? What were the key drivers? What's happening in physical markets for gold?
Yeah, certainly. So if you look at the pullback that we had in Q1 of this year, it was one of the worst or most significant declines on record for a calendar quarter. But in many ways, it was a continuation of the consolidation/correction period that really dates back to August of 2020. And obviously back then, gold was trading at around $2,050 an ounce. So, all-time high in nominal terms, really significant enthusiasm in markets. You had analysts, predicting $2,500, $3,000 gold was next. A lot of froth. Investor sentiment was basically as high as it had been. And that's typically a pretty big warning sign. And what we've seen over the last 6 months, which obviously includes Q1, is all of that froth come out of the market as gold has, in US dollar terms, we're talking here, pulled back around 20%. So from my perspective, I sort of largely see it as a healthy correction in an ongoing bull market that kind of dates back to 2015 now. And the really encouraging thing from a technical and sentiment perspective was that by the end of March, as I say, technical sentiment readings and the like, they hadn't just worked out the froth, they had actually gone all the way back to kind of like peak pessimism levels, which typically is a good sign to start reallocating capital into a market. In terms of what drove it, there's a handful of factors. Equities were incredibly strong. The S&P 500 has breached 4,000 points. Real interest rates actually rose significantly. So even though inflation expectations have risen, the increase in nominal bond yields has been a more significant factor. You also saw or have seen, I would say, a lot of economic optimism, even though we know COVID is the threat that it is, and even though we know we haven't sort of fully dealt with the problem. There's been, obviously, this rollout of vaccinations across the developed world, and that has encouraged investors that the worst is likely behind us. And then I would say the fourth point, which is probably a good segue to some of the other things we'll talk about, is really from I suppose Q4 last year through to Q1 this year, we've seen this just incredible rally in crypto. And of course, crypto is particularly Bitcoin is sort of constantly marketed as digital gold. And so there's been an element of, let's call it investor rotation from precious metals into, very fast rising cryptocurrencies, or I should say fast rising up until a couple of weeks ago, and some of the airs out of the bubble recently.
Yeah, it's interesting, isn't it? Because it is the psychology of markets. And when gold starts to get stronger, and I often say to people, look, don't sell your house and your children and go all in, but you should have some allocation to the precious metals market, be that equities or the physical. But I personally like the physical as well as equities. But I think again, don't put all your eggs in one basket. But we are in a market at the moment. We've got lots of money printing going on. There's a lot of what I call the funny money sloshing around, looking for a return. So as you mentioned, it's gone into the cryptos. It's also gone into the equities markets as well. Do you think that will continue, or do you think that there will come a time when the psychology will turn? And I've said it for a while now. I think the second half of 2021 will be very, very good for physical gold.
Look, I think if you sort of go back 20 years, the gold price has gone from, again, let's use US dollars, sort of under 300 to over $1,700 an ounce. It's outperformed most mainstream asset classes. It hasn't outperformed crypto, but that's a separate story. So I would say that the entirety of the let's almost call it the new millennium has seen or has been an environment where investors are realizing the need for safe haven assets like gold and are allocating parts of their portfolio to it. So it's really easy to get kind of caught up in the last week, the last month, the last quarter. But if you look at the trend over the medium to long run, it's very clear that investors are moving towards hard assets and precious metals, and gold in particular is a major beneficiary of that. As regards the kind of momentum, I suppose, in the short term that's really benefiting other asset classes or has of late, you can already start to see it come out of crypto a little bit. I think Bitcoin is now trading down at or just below $50,000 a coin, so it's pulled back 20% in a couple of weeks or thereabouts. Equities still do look pretty strong, and I think gold really thrives when it's outperforming equities as well as just going up in its own term or in its own right. So I would say that from a relative point of view, gold it's kind of treading water right here. It's not performing badly. It's kind of rallied a little bit here in April, but the reasons to own it in a portfolio have not changed in any meaningful way.
That's what I want to get into, because we've got a lot of people on the conference today, some of whom are just beginning to dip their toes into hearing about gold, wanting to invest in gold. Now, you are head of listed products, but you're also investment research. What would you say to people that say, I don't even know where to get started? I mean, we heard earlier today from Janie ABC Bullion about the basics, the ABCs of investing in gold. But what I want from you is, why do you think that if people are listening to you today, with the gold price still being a little bit, not really doing very much, but the equity market's on a tear, crypto, people are still talking about it, what are the core reasons that you believe to protect their purchasing power in what could be an inflationary period? We don't know at the moment, but you're saying it's here. Other people are as well. Just break it down to the basics for us, for those listening, what Jordan Eliseo's view is on people's, what should they be doing at the moment? Because quite often people are saying, well, I don't know what to do. And if it's not going up in price, because that's all they look at. They look at price. I don't. I look at purchasing power.
Sure. Well, so I have to start by putting the standard disclaimer out that we can't give advice on what anyone should do in particular. As regards the reasons to own gold, look, the potential for higher inflation is one reason that investors typically look to gold, because it has it very clearly has the longest track record of preserving purchasing power. So, if you're an investor saying, well, there are 100 different things I could do to try and protect purchasing power, what is the simplest, what has the most established history, then gold stacks up very well against the vast majority of alternatives that they could look at. The reasons to own gold, though, aren't purely around high inflation, though. If you look at, we talked a little bit about the last 20 years as an example, where gold has outperformed most mainstream asset classes. The last 20 years, at least in terms of official consumer price inflation, have actually been quite benign. So gold can perform very well and can play a positive role in a portfolio, even if inflation's quite low, because there are other things that can disrupt financial markets. You can have recessions, stock market crashes, obviously pandemics now, you name it. So gold's role as a source of returns and as a source of wealth protection is multifaceted. It is very clearly not limited to the sort of it protects against high inflation argument, which is sort of one of the narratives that's out there. So I think from an investor's point of view, this is a bit of a roundabout way of answering your question, but if investors are saying, I want to allocate part of my portfolio to an asset that is very, very liquid, very easy to trade and to store and to have exposure to, and I ideally want that asset to be something that has had a track record of performing well over the long run, and in particular in environments of higher volatility or inflation or the like, then, once you sort of tick through the list of asset classes you could look at, gold is probably going to come up pretty highly on the sort of list of ones that you might want to turn to. Other asset classes don't offer, quite the range of potential benefits gold does. So, some people will just go, I'm worried about the equity market crashing, I'll keep my money in cash. So that's fine. Your cash will hold its purchasing power on a day-to-day basis, but we all know on a year-to-year and multi-decade basis, it won't. It's designed to lose its value. Some people will look at crypto and, from one day to the next, they might see the prices of Bitcoin or Dogecoin or another cryptocurrency going up 20 or 30%. The reality is they're very likely to wake up the next day and see it, down 20 or 30%. So, the volatility that's there, not to mention those assets are incredibly nascent. They haven't been around for very long at all. So they don't have that track record that people can feel comfortable with yet. So, yeah, it's not about saying, gold is the be all and end all and the one solution that every investor should turn to or should be putting all of their money into, but it clearly stacks up as an asset that can deliver multiple benefits to investors.
It would be remiss of me not to talk silver as well, because the Perth Mint does deal with gold and silver. Does silver behave in the same way as gold? That's what people have. I've been having questions from people saying, well, I don't have a lot of spare cash around. Should I put a little bit into silver? Does it behave the same way as gold does?
Look, no, it doesn't. It's kind of in many ways, it's like a high beta version of gold. So when gold is doing well, silver can often outperform. If gold's having a bit of a pullback, silver, it's not unexpected to see it underperform. But from a safe haven perspective, particularly if it's an environment where equities are falling and maybe there's uncertainty regarding the economy, then silver, because it's partly treated by the market as an industrial asset, doesn't necessarily provide the same portfolio benefits gold does. So don't get me wrong, I have a reasonable position in silver personally, and I think there's a very good chance that with a medium to long-term view, it will at least hold up with gold, if not outperform in certain market environments. But it doesn't behave the same way, from a portfolio perspective or just even looked at as a standalone asset. It's more volatile, and it doesn't always necessarily, provide that kind of offset or that hedge that gold is, I suppose, better known for.
I want to talk about the Perth Mint. There are people out there going, well, how do I buy? How do I do anything with the Perth Mint? Let's just talk a little bit about Perth Mint. Then I want to go on to what you mentioned before, which is crypto. Even though this is a virtual gold conference, it is impacting where people putting their hard-earned wealth or money, funny money at the moment. With the Perth Mint, people can buy. Talk to us about the different ways that they can purchase precious metals via the Perth Mint.
Yeah, sure. So there's three primary ways. The obvious one is buying physical bars and coins, which people can do from us directly, or if they're located in another state and want to look for a distributor. All of our distributors are published on our website. So if someone wants to buy it and sort of store it at home or the like, then they can either buy it from us direct or buy it from a distributor in their local state if that's what they prefer.
Does it cost? Sorry to interrupt you, but I want to get all this out there. Does it cost more if they go through a distributor? In other words, is there a little bit more on the price?
Well, look, there can be, but it may also be that they then save on some shipping costs, for example. So it might come out as a wash kind of thing from a cost perspective. It's sort of not really. I can't really sort of speak about the price every distributor charges for every product, as it were. The second option, which is very popular, is opening what's called a Perth Mint depository account, where investors can buy and sell precious metals with the Perth Mint, and we provide the custodial service for the precious metals. So it never gets delivered to the investor. It can be if the investor wants it to be, but up until they ask us for that, we will just store the gold and the silver, platinum, etc., on their behalf. And so the advantage of that is you don't ever have to worry about the logistics costs. You also benefit from the Perth Mint government guarantee that applies to all of our depository holdings. And it's also, as a general rule, more liquid because, if you've got your gold at home, it's then a bit of an effort to go and sell it, as it were. Whereas if it's sitting with us, it's, log into your online account or call up during trading hours and you just lock in a price there and then. So that's the second method. And then the third method, which is increasingly popular, is just using the ETF that we have on the Australian Stock Exchange. So the ticker code for that is PM Gold, and investors can obviously buy and sell that like a regular share. It's got by far the lowest cost of any gold ETF on the market. The management fee is just 0.15% per annum. So if you've got $100,000 invested, you're effectively only going to pay a storage fee or a management fee of $150 a year. So that's a really cost-efficient and popular method of incorporating gold in a portfolio. There's no right or wrong way. It's just it's clearly a case of investor preference.
Now, you might not know the answer to this, George, but I'm going to ask you anyway. Are you seeing more going into depository or PM Gold or physical? Are there any trends that are coming out for 2021?
Yeah, so it's always about the sort of the time frame you're looking at. So over the last couple of years, we've seen really strong growth across all of the three main options that I've talked about there in terms of how people can allocate to precious metals. And so to give you an example, within our sort of physical business, i.e. people taking delivery of bars and coins, if we look at our minted products, Q1 2020 was the highest calendar quarter for sales in a decade, basically. And That's for gold. And for silver, it was the fourth highest quarter. So really, really high levels of demand being seen there. On the depository side of things and on the ETF side, we've seen things sort of start to stabilise over the last 3 or 4 months. But that's coming off the back of basically a record 2020. So, for example, I think in the 12 months to July or August, PM Gold, our ASX-listed ETF, I think it was the second fastest growing ETF on the ASX in terms of the increase in its value. Now, part of that was driven by the gold price rallying, but it was also driven by very, very significant investor inflows. So, yeah, we've seen growth across the entire suite of products that we offer. Different areas of the business, for want of a better term, will see stronger levels of demand in, depending on which quarter or month you're talking about. But there's a real increase in appetite for precious metals by investors.
Perth Mint also have a lot of different products when it comes to bars and coins. What are the difference, and why would people look at all those different? I mean, it's confusing for some people.
Yeah, look, it's partly it's about investment budget, right? So like a kilo bar of gold is the average self-managed super fund trustee can buy one. If they're putting, say, 10% of their money into gold or into precious metals, for probably a younger Australian getting started on their investment journey, kilo bar of gold is probably going to be beyond their reach, as it were, or their budget. So they might want a smaller bar or a smaller coin, or indeed that's why they might use an ETF or a depository account where they can put a fixed dollar value in, or a notional dollar value, and get sort of fractional gold ownership, as it were.
Okay, I want to ask you a little bit around, there's a bit of talk about, do you think the governments would ever, because let's just go back a step. Right now, lots of money printing going on, lots and lots of debt, government debt in the world. And I can see taxes going up, and I can see governments starting to get a little bit concerned about things. Do you think that there's ever going to be a time when we, if you go back in history, when you remember the US government, they confiscated private ownership of gold. Do you think that's ever going to happen again, Jordan?
Look, Kerry, it's a
hard one.
Well, it's an impossible question to answer. I think people that think it's going to happen, and nothing is going to disabuse them of their belief.
Right.
If you look at the size of the gold market relative to the size of public debt levels in across the developed world, confiscating gold would make no difference to the liabilities of Western governments. It would ostracize voters. I can't really see the logic behind it. But yeah, I mean, ultimately, if people want to believe that that's going to happen, then there's very little that I can say that's going to disabuse them of their notion.
Now, Jordan, you have written in the past a little bit about gold and Bitcoin. I'd love to hear your views. You spoke about earlier that, the volatility of the crypto space. Gold has been known as a safe haven. Is Bitcoin a safe haven as well, or do you think its volatility means that you can win, but you can also lose big time?
Yeah, look, I think that volatility is one factor by which you might measure a safe haven asset, and on that score, Bitcoin ranks poorly, as do most cryptos and most high tech stocks and the like, because they are volatile and they suffer massive drawdowns. It's obviously been an incredible performer though over the last 10 years, and so well done to anyone that's been long over a multi-year time frame, because they've probably made some very good money. The challenge with Bitcoin from a safe haven perspective is that it has only existed in an environment that's largely been categorized by rising equity prices and really low inflation. So if you sort of say, well, when we talk about a safe haven, there are multiple reasons why you might want one in your portfolio. But in terms of its the market impacts, there's really only two that you need to think about. It's, are equity prices or risk assets going to crash in nominal terms? Or is inflation going to rise so much that the purchasing power of your assets declines? And Bitcoin just hasn't been around long enough to even go through an environment like that. So, and if we look at the whole 10-year period it's existed, or 10 or 12-year period that it's existed, has largely been categorized by rising asset prices. However, there have been pullbacks along the way. And if you look at the pullbacks that have occurred, and Q1 2020 was a perfect example, Bitcoin, as a general rule, has sold off whenever equities have sold off. Whereas gold, on the other hand, if you take the broad sweep of history, it has tended to be the best performing asset when equity markets and risk assets sell off. So from that perspective, I don't think it ticks the box from a safe haven, as a safe haven. Obviously, Bitcoin bulls would disagree, and they would say, well, it's a safe haven against money printing, and there's perpetual money printing, and it's going up in price. Therefore, it does tick the box. But I think most mainstream investors, and particularly institutional investors and the like, that when they're trying to measure a safe haven asset, it wouldn't yet tick the box for the reasons that I've described. Gold, on the other hand, it's incredibly liquid. The market size can easily absorb institutional inflows and outflows. The gold price can't get moved 20% in 10 minutes because the CEO of a listed company tweets about it, for example. All of that stuff, if you've got money in Bitcoin and it causes the price to go up, you think that's great. If you're an institutional asset allocator, that kind of stuff is terrifying and scares you away from wanting anything to do with an asset class that has those characteristics. So, yeah, it's not about being anti-Bitcoin by any way, shape or form, just like I'm not anti-equities or bonds or cash or anything like that. But it's just about understanding, okay, if you're looking to allocate money to this asset class, or comparing it to gold, just make sure you're comparing it on a range of metrics, from liquidity, market size, the regulatory environment, its actual, market history in terms of environments where equities sell off or inflation picks up. And you'll see gold there's a reason why it's so well respected and trusted as a safe haven. Bitcoin may become that one day. It's probably still too early to say, though.
Jordan Eliseo, I'm afraid we've run out of time. Gosh, that was a quick 20 minutes, but we'll see you at the Australian Gold Conference in October this year. In the meantime, thanks for joining us on the Virtual Gold Conference today.
Pleasure, Kerry. Anytime.